Thanks for tuning in to the All Funds Network. Today we're here with Nicole Belmont of Far Hill. Nicole, thanks for joining us.
Thank you for having me.
Yeah.
Absolutely. Why don't we kick it off? Let's start with your background, and then we'll get into kind of where we're at today and what you guys are working on.
Sure. I've been here for 24 years. So a good part of my career has been at Far Hills Group. It's a big number to say.
Yeah.
Actually, everybody's been here a long time, which is nice. So the firm itself has been around for 35 years, but I mean, Jeff Mack's been here since 94, Mike Halverson, 98. I think the sales team on average is working together over 15 to 17 years. So it's nice that everybody's been working together with lots of different market cycles and environments and a lot of continuity for the managers that we work with.
Yeah, that's very exciting. That's quite the milestone. Yeah.
We're a placement agent. We raise assets for hedge funds, private equity, private credit, venture, really anything in an alternative structure. And we do that globally. We have two sales teams, one covering North America, one covering international markets, but everybody works on every assignment. And then my role is manager sourcing and diligence. So finding the managers for them to sell, and then really anything behind the sales once we're working with the fund manager.
Very cool. Well, we got a lot to get into today. Why don't you start with talking to us about what's the difference between a placement agent and maybe like cap intro services?
Sure. So it's funny because a lot of people think it's competitive, but it's actually very complementary. A lot of the referrals that we get are from Cap Intro. So, Cap Intro is working with a lot of funds. And when they have managers that want more high touch, oftentimes they'll refer it to us because we're essentially an outsourced sales and marketing department for the manager. So we could work on their marketing materials, do their marketing materials. We have a salesperson in every meeting with the manager and doing all the follow up. Where Cap Intro is, setting up really introductions with the manager. They have, like lots of investors that they speak to, and they're finding, the investors they think are be appropriate and make the introduction. And then the manager is responsible for the meeting and follow up. So it's different in that sense. We work with them a lot. A lot of times when we're working with a fund, we'll collaborate on events. Like say Cap Intro is having an event, breakfast in Dallas. It will help them fill the room by getting some of our prospects in there as well. So it's collaborative, it's complementary. Also, we get paid differently. Cap Intro is essentially a free service, somewhat free, that you're getting with your suite of prime brokerage. And we get paid on assets raised. So it's more directly related where we're really needing to bring in the assets for a manager or we don't get paid anything.
Yeah.
Mhm.
Makes sense.
Got it. And I'd say kind of before we move off like the placement agent, kind of what you guys do. Tell us a little bit about like what type of funds use a placement agent. Maybe, if you want to talk about like AUM, I think
Sure.
that's probably the most relevant thing, but I'll let you kind of take it away.
Sure. So for us, our sweet spot's a manager that has, say, 50 to 250 million in assets. They've exhausted their friends and family, and they're looking to grow institutionally. I mean, it's different though with other placement agents. There are placement agents that will, look at managers smaller. There's also managers that are large, very large, maybe several billion that use a placement agent, just that a placement agent's working off a list for them and just providing some coverage that they already don't have internally. So it's a very fragmented industry where there's so many different types of relationships. So really any size of a manager can work with a placement agent. Typically the placement agents though just have different sweet spots. Like our investor base, a lot of it is family offices, about a third of it. And that really goes to our, late stage emerging manager focus. And that said, we do work with large managers also though, that just don't want to build out their internal marketing department. But often you'll find, several billion-dollar fund is more so working with a placement agent that's working off of a list or maybe a region. Sometimes it'll be a regional assignment. Maybe they want someone that just covers Asia for them or, just covers South America or a different region.
Yeah. I guess maybe you can talk a little bit about kind of just that relationship with your client. And obviously getting them prepared to have those conversations is probably a full-time job in itself, I'm sure. But
Yes, and that's a lot of what I do is that starts really when we're doing our diligence. So we're doing the same diligence that any institutional investor is doing. But in parallel with that, we're also thinking about first getting that manager set for operational diligence. So we want to make sure that when we bring a fund to an investor, maybe they're not the strategy that they want, but they're going to check every box for, the operational diligence team. So that might be, putting some different policies and procedures in place, enhancing their compliance manual, the service providers that they're working with, maybe outsourcing C-level that if or other roles that they don't already have that'll be needed. And then on the other more marketing strategy side, we're also thinking about differentiation, messaging, really, what makes that manager stand out from all the other managers and competing for the same capital, and ensuring that comes across in meetings and marketing materials. So we're working on their marketing materials. We're putting a core set of materials together for them, and then ultimately having a salesperson attend, each meeting with them. And then in the beginning, it's a lot of, coaching, getting that pitch really down pat, making sure that the presentation works in the meeting, that the manager is really addressing all of the points that you want to get across in order to get to the second meeting. So it's a lot of, upfront work, but then it's more streamlined after that. A lot of times, we'll want to get a core set of materials that might be a monthly data packet where it has your, say, a long short manager. It's going to be exposures and attribution broken up by long and short, but also market cap, geography, sector, and really just compiling all that. And it could be a big project for managers that don't start doing that early, but they'll see that once we're working together and they're in institutional diligence, it's going to be asked for time and time again. And it's easy just to then investor ask for it, send, push a button and it's sent out to them rather than having to recreate something each time. So it's really, operational policies and procedures, marketing, pitch, and messaging, and then really data. I think data has been a large part of the sales these days, where investors are really doing a lot of work and digging in on their own.
Yeah, definitely. I'm assuming that front end process from a diligence perspective can vary based on time frame, based on if the manager has everything consolidated, ready to go, or they have to peel through the pieces of the puzzle, shall we say, to get to.
Yeah. And we do a lot of help with them too. Sometimes they're like, oh, well, we changed prime brokers 3 times and we don't have it. And how do we recreate it? And we try to help them do it. But it is really nice when it's already prepackaged.
For sure.
So it's good for managers to really start tracking that right away. I mean, if you're doing it just on a monthly basis from the beginning, it's so much less work, than going back years and trying to kind of recreate the wheel and remember what the market cap was at that time, or what just remembering everything for each position.
100%. Got it. So to summarize it, you guys do everything for the investment managers.
Pretty much. It's really outsourced sales and marketing. So, everything for the sales and then behind the sales. And, a lot of times the managers, if they have, a strong IR component, they're not going to want everything that we're capable of doing and willing to do. But a lot of times with the more emerging managers, they don't have somebody in that role. And then, later on, we'll transition that as they bring somebody in.
So you're kind of you really look on the front end for any gaps and any deficiencies to kind of fill those gaps by a well-honored offering, and then you go out to market it, essentially.
Exactly.
Okay. It is a full-time job.
Yes.
Could you tell us kind of about like the fundraising environment, maybe that you've seen over the last like couple years and kind of where we're at today?
It's been, well, obviously 2020 was terrible. 2021 was one of our, best fundraising years. Yeah. 2022, 23, 24 were okay. And then we had really high expectations for this year. And that seems to have come to a standstill a little bit. I think people really right now are just managing their portfolios and, seeing what to do. And a lot of people on the sidelines not willing to put capital to work.
Yeah.
But hopefully that'll change. I mean, that said, it's really a time though for managers that are outperforming these markets to really shine, because if you have managers that were positive in February and March, or even positive on both sides of their portfolio in February and March, and then up in April, they're going to raise capital because people are going to say, wow, how did you do that? And even years from now, 2-3 years down the line, people are going to point to these months and say, what was your drawdown? How did you do? So, and also just at any time, if it's a good manager that's differentiated, producing, returns relative of market conditions, I think there is capital to be raised for them. But it's just the overall market environment, especially in equities, U.S. equities is just so hard right now. We're still getting a lot of interest in lower middle market buyout, life sciences venture as well. So on that side of private credit, I was saying digital assets is probably still pretty popular right now. We don't have anything in this space, but I'm sure it's got, attractive attributes. But I think just like the U.S. equity market's really hard right now.
Yeah. Are you seeing, I guess like you have an interesting perspective here. Like, are you seeing people kind of buckle down over the last couple of months, like take what they already have and just kind of leave it? Or are you kind of seeing people rethink some of the things they've been investing in over the last couple of years?
I think that, we've definitely had investors taking a pause, with bringing on new mandates and just seeing what I think that will be, but I just think people aren't really sure what to do right now.
Yeah.
It's like, do you get out of positions or out of the market at a loss when 2 days from now it could go up if trade tariffs are figured out? So I think people have that apprehension, like, yes, you want to get out because you're scared, but then you also have FOMO if you do get out and then the market.
Right.
That's kind of what we said before. Like, a lot of managers, going to cash or taking their positions down, then not getting the rallies. You can't time the market. It's just so unpredictable right now. So I don't know. It's hard. I wouldn't want to be a portfolio manager right now.
No stress. Yeah.
Right. They know as soon as you hit the sell button, the market's going to start going up.
Yeah. It's kind of hard to, it's that emotional roller coaster too. I talked to some managers who are like, hey, this is a great time for us to launch given the downturn in the market, to have a good performance riding the wave, if you will, or, but is it over yet, right? What happens if you start now and things don't go well? But so to your point, it's hard to kind of know what's the right answer.
If you're relying on a seeder, are they still going to seed you right now? Are you still going to get that initial capital for a new manager? I don't know.
Yeah.
Right. So let's talk about the fund side of things, because I'm sure you get a lot of questions from, funds on the day-to-day. Maybe let's start with, you kind of walked us through the process a little bit earlier, but just like preparing funds to take capital, kind of like what's the first step in your team's book for kind of getting fund managers ready for everything?
Well, one, operational infrastructure, making sure that that's quality, policies and procedures in place, making sure good service providers, and then, strategy. Also timing, you have to go out to market when it's the right time. To go out to the market in a drawdown or flat performance, relative to your peers may not necessarily be the right time to go out, unless you're in that drawdown, but you're pounding the tables that now is the greatest opportunity to get in because I have all these insights and ideas and see these opportunities. But if you're just in a drawdown and that's not the case, maybe it's not the best time. So one, timing, having strong performance, having your, best foot forward to go out to investors. And then, thinking about your messaging, making sure that your strategy, that you could articulate it clearly, practice for your presentations, be able to have enthusiasm, sell your messaging, sell yourself, your ideas, be excited about what you're doing in your portfolio. So that, and then, having quality marketing materials, like having a good pitch book. You don't want to go to potential investors if you don't have a good pitch book or one pager or whatever type of email that you're starting with, because that's the first impression that investor is getting. So I think, starting with the outreach being a quality message with materials, making sure that your pitch is down pat, if you're doing a Zoom, that you're background or no noise in the background. Just things really making sure that it's practiced. And then ultimately, being able to pitch them and show that you're different, show how your alpha is being generated. Also, following the meeting, be able to be transparent, be able to provide the information that the prospective investors are asking for, and also follow through, a lot of follow up. A lot of times, if a manager is doing it themselves, it's hard. It is a full-time job, like we said. So to be able to follow up with all of the investors and prospects after you're done with your day, it's hard and it's a lot to take on. So I think really trying to manage the process and seeing what other, whether it be, third-party marketing or an internal marketer or utilizing cap intro or cap intro type services, really, using your resources appropriately, or even just taking some stuff off your plate that you could allocate to others, within your organization.
Yeah.
Yeah.
Makes a lot of sense. Obviously, having that initial conversation, you're preparing them for that. I mean, they're following up. What does a typical back and forth, look like from a start to finish, and how you guys are kind of helping throughout that process? You mentioned a few things on the front end, but as you go through that process.
It could take months and years, even sometimes, like from an initial meeting with an investor to the time that they allocate. I mean, there's other investors like family offices or, high net worth individuals that are able to move much quicker and maybe just have one or two meetings. But a lot of times the institution is going to take definitely several months, whether it be, the initial monitoring and getting to know you. And then a lot of times you'll visit their offices initially, and then they'll come visit your offices, and then get to the point of, after it's passing operational muster, having to go investment muster, they're going to the operational diligence team to come in, and then eventually going to the investment committee for approval. So in the larger institutions, it's definitely a much larger process. And we try to stay involved in all of that and push it forward and, move things along, whether it be, the nudge of, have you had a chance to look at their latest numbers, or did you see this news that came out, or just really trying to put that value added communication in front of the prospective investor to keep them engaged, to make sure that you're in the front of the mind, and just kind of keep trying to move it along from step to step until it eventually comes to fruition. And as I said, it could be a long process that managers a lot of times get frustrated, but hopefully eventually you get rewarded.
That's right.
Yeah, 100%. It sounds like for like most fund managers, especially if they haven't been doing this in the past, like it really helps like having somebody like your team there on the sales side.
Yes, definitely. It helps a lot. A lot of the funds that we work with don't have anybody in that capacity. Essentially, it's either the PMs doing it initially, or somebody in a C-level role, that's CFO, COO, CCO, and business development.
Another thing too about like key man risk too, like as just certain investors pay attention to that, versus a 2 to 3 man or woman shop. What do they look for? How do you guys maybe talk about that with your clients?
Yeah, it's definitely an issue. Like who's going to be the compliance officer, has oversight. And a lot of times if they're not or willing or wanting to bring somebody on the operational side in initially in a full-time position, we definitely encourage them to outsource that role.
Yeah.
Whether it, compliance consulting firms, or just, operational consulting firms, just really to have that professional oversight and, brings the comfort to the investor. I think the whole one-man band concept is really hard for institutions. I mean, high net worth individuals are more opportunistic, but for an institution, it's harder.
Yeah. Makes sense.
What have you seen in terms of like, what are some of the biggest reasons that managers don't get funded?
Bad performance. That would be first and foremost. Going out to the wrong audience. Sometimes, like a lot of times, we'll talk to like a small manager, and the sovereign wealth funds are going after, and big, huge state pensions. Those big institutions might have emerging manager programs, but a lot of times their definition of an emerging manager is very different from other definitions of an emerging manager. Like their definition is a few $100 million maybe in a few year track record, not 10 million, in a 1 year track record. So really, knowing your audience, and a lot of times Cap Intro could really help you with that a lot of, really identifying who the early adopters are, who could move early, focusing on the right individuals, whether it be family offices, high net worth, maybe RIA channel, people that know you, going through your network, that people know you, they know have you performed in the past, and, willing to take a chance on you. So definitely, and then, doing well in their presentation, having the quality materials. But really, I think the major thing is standing out performance wise. And then, if you're not fully institutional, being able to show a business plan of how you plan to grow and what resources at different asset sizes you're willing to put in place, that you're acting as a larger institutional offering, even though you're not.
Yeah. That makes sense. Yeah, I could see definitely performance is probably the main driver in most situations.
Yeah, for sure. Yeah. I'm curious, what are investors, obviously, they're looking at the obvious things, qualitative and quantitative review of things, but maybe from an economics perspective, are they asking for, a different fee schedules, side letters? What's that look like these days?
Yeah, for large investors, they're definitely asking for a fee discount. Yeah. So, the large investors, depending on the manager's size, it varies in how much clout that the manager has in their negotiations, but definitely fee breaks, a lot of side letters for most favored nation.
Yeah.
But fee breaks definitely, especially if it's a large SMA. But a lot of the smaller managers, are using the founder's share class effectively too.
Sense.
But fee breaks are definitely something a lot of people want. And, just have to be careful with, just to make sure that you're giving it to the appropriate investors at the appropriate times, because then you should offer it to everybody. If you're going to offer it to maybe $5 to $1 million ticket, a few years in, and then other people are going to come in, they're going to do their diligence, they're going to ask if anybody has better terms, and then you're going to have to offer it to others, or they're going to have their MFNs in their contract. Yeah. So it's just really being smart about, the fees that you're negotiating, and knowing that it could be really good for you now, but how it's going to affect your growth plan later on.
That's a good point, actually. Could you dive into that a little bit more? If to what degree do fund managers need to expose their fees? I assume the fees are probably written in the, offering documents, but in terms of if you give other investors deals, does that need to be disclosed?
I wouldn't say, I'm not sure. I don't see it disclosed readily in the materials, more so in a DDQ, or either just a generic DDQ, like an AIMA DDQ, or the managers or the investors DDQ. The question being, are there any side letters in place?
Got it.
If there's side letters in place, could you give insights? Is it better liquidity, better fees? What better terms are those people getting? So, and then especially if you're a large investor, it really gives you the ammunition to negotiate.
Yeah. Well, and to your point earlier, which you said, Nicole, if you ask for a most favored nations clause, you are the best deal. There's already a better deal on the table. Well, then you're going to get it too, right?
Yeah, and it could hurt investors, because sometimes they'll, have an early investor and they'll do a side letter, not thinking that how it's going to affect going forward, that they're not going to be able to offer things that would help them grow a lot in the future.
Right. It's a great point. Maybe it's a good friend and you want to give them a deal, and then they're investing $100K, it's not a huge check. But then you have to have that conversation with your future investors.
Exactly. And it's very, it's acceptable, early on, when it's, the person backed me when nobody else did and they got in early. Everybody understands that. It's more so the more abnormal off the cuff circumstances.
On a similar note, could you talk a little bit about how investors are thinking about using anchor classes and anchor investors for their funds?
Yeah, I think it's great, and great to get a good anchor, to really back you in the beginning and, grow with you and hopefully stay for the long term.
How do you kind of think about anchor? Is it somebody that's going to put down, like a very significant percentage of the fund, or?
Yeah, I mean, usually it's a good amount of assets, and that size that they're putting in is relative to
the
what they're
fund
getting, whether it be, are they getting, I mean, best case scenario, they're just getting discounted fees, but a lot of times they're going to want a revenue share, and just seeing, what that's going to be and how that'll affect you also going forward. Because a lot of times if you're giving away like a seeder, a revenue share, if they're taking, say, whatever percentage based on their investment, it's harder than to bring in a placement agent at times later on, depending on what your capacity is. Like if you're growing to several $1 billion, maybe it's not a big deal. But say it's a microcap strategy and you only want to raise 200 million. Do you want to, give the seeder 20%, a placement agent 20%, and then, you still have to pay your team knowing that your, capacity is not infinite. So, it's a lot of stuff to think about, but anchors are really important. We try to maintain a list of like seeders and early investors that we give to smaller managers that come to us that are looking, really to get that capital up front and be able to try to get institutions looking at them.
Yeah. Are you still seeing in terms of like fees, is 2 and 20 kind of the common go-to, or what are you seeing these days?
More like 1.5 and 20, 1.5 and 17.5, 1 and 20 maybe. But
is that what you've always seen, or is this kind of a newer trend, or are margins being compressed here?
I think they have been over the last few years. I think they're stabilized over the last few years, but they had been really compressed. For the long short, if it's a very specialized small capacity strategy, I think you maybe can get 2 and 20. But for, more general strategy, they're not getting 2 and 20 unless the performance is off the charts. And long only is typically, over a benchmark or some kind of hurdle.
Yeah, that makes sense. You mentioned earlier about just kind of having the right investors, right? Some people are talking to the wrong investors early on. Obviously, to your point earlier, but it's probably a balancing act. Certain investors don't want to be the majority stakeholder in the fund, right? For obvious reasons.
Yes.
Maybe you can talk a little more about that.
Yeah. A lot of times the managers come and they say, well, I have all these people that don't want to be more than 10% of my fund, but if I got them all to come in together, it would work.
Right.
And it's just hard to do that, unfortunately. Yeah. But that is a gating factor a lot of times up front, where investors, sometimes they'll phase in their investment, like as the assets grow, they could put more in, but that's a hurdle up front. Yeah. So maybe family offices or other type of investors, which don't have those restrictions, are great earlier, but it does become a problem with internal guidelines of certain institutions where they're just simply not able to be, larger part. I mean, sometimes you could take the firm assets into rather than just the fund. But if it's the fund, if they have hard restrictions, it's hard.
Yeah. Makes sense. Let's pivot to kind of the due diligence side of things. So, from your team, can you kind of just give us at a high level kind of the process of what you guys look at as you are maybe onboarding a new fund?
Sure. So we're looking at the strategy and really digging into the numbers. So we're looking at, positions. We're trying to figure out attribution, where the returns were generated. Was it from just a few positions, or was it spread out over a lot of positions? How they performed in different market environments, to their peers, how they were positioned, whether it be, market cap, sector, geography. So really digging into all the numbers, really getting to understand the strategy, making sure that it's repeatable. Because a lot of times also you'll see with a small manager, what they're doing at, say, 20 million, they can't do at a larger amount. So are those returns going to be repeatable once they grow? Really ensuring that. And getting to know the team, making sure, you want to work with someone you like, and you know that it's a good fit and a partnership. So really getting to know the other side, and making sure that everybody's on the same page, and it's going to be a collaborative working relationship. And then operationally, we're looking at the audits, we're looking at the PPMs, all the legal offering docs. We're looking at the compliance manual, operational, like cyber, anything, disaster recovery, business continuity. We're making reference calls. A lot of time, importantly, we're trying to make the reference calls that they don't give us, because most likely you're going to give me people that are going to say really good things about you, but try to find, some degrees of separation where you can get some, off the sheet references.
Go find their old manager on LinkedIn.
The last, the service providers, a lot of times I'll be, oh, they worked with you guys, but just like if they're timely with information or just back and forth. We'll do service provider confirms, make confirmations that the service providers are working with them and, the services that they're providing. We also do professional background checks. That's the one thing that we do outsource to a third party. And we do that, and really just digging in and find out as much. We want to find out as much as we can about a manager. So when we're out on the market, nothing is going to come as a surprise, and we're going to have everything on hand and readily available for others who are doing their diligence.
Any interesting red flags that have transpired over your career that you can share?
Yeah, the one would be kind of going back to that is saying to people, listen, we're moving forward. We have every intention of moving forward with you. Once we dig in, is anything going to come up?
Yeah.
And then for them to say no. And then things come up and you're like, you knew we were going to find out about this. Like, why wouldn't you have just been upfront? Because sometimes it's not even a deal breaker, but it's a deal breaker because you didn't tell us.
Yeah. What are these things? Is like you got, arrested for a drinking ticket in college, or
something like that, or, something silly, or, a lawsuit, something, just anything, right. Just to be upfront. I mean, we'll look at their, the ADVs and see if there's any disclosures and U4s and whatnot, but just nothing to come up as a surprise.
Yeah.
You also, of course, you're scouring, website searches and internet searches to see anything up front too. There's been some interesting things comes up before the first meeting where you're like, what?
I didn't talk about that in the last meeting.
But things don't really, it doesn't happen often, but it probably once every few years where you'll say, people, it's appreciative if people are upfront of, okay, this like you said, this happened in college, or, this happened and we're, borrowed a bike from somebody, and you're like, okay, I get it. Like, as long as it's not something bad, but a taste in your mouth. Because if you're getting everything in this industry is your reputation, and we don't ever want to partner with somebody that doesn't have a good reputation or is going to sully our reputation.
Yeah, it's a great point. You kind of went through like your team's due diligence. Is when it comes to like investor due diligence, are they looking for a lot of the same things, or is there any things that they're looking for that maybe are less important to you guys?
No, it's a lot of the same things. It really is.
Makes sense. I guess maybe going on top of that, as you guys get them ready for prime time, shall we say, going out to investors, are there any industry events that you like, that you see as trends that you like your clients to go to?
We've gotten, good meetings there, with great investors. We go to the Miami one. Typically last year we went with 5 different managers. Mm-hmm. I haven't been to them personally, but I've heard good things about Inversion and Santangelo and McGuire Woods.
Yeah.
And Super Return.
Okay.
When it comes to like going to events, like, any advice for managers to get the most out of going to these events?
Yes. So that's one thing that we do, because when we go to iConnections with the manager, we take over the portal, the scheduling for them. And it's a lot of upfront work, making sure that you're sending the invites, that you're responding, that you're getting in front of the right people. You're getting in front of the investors that would be a fit for you. and just being really proactive in contacting them. So I'd say really doing the upfront work and also, registering early so you get the access to the portal right away and not later on when most meetings are already scheduled. Like being on time, timely with it, getting your information up there and updated, because usually you have to put your tear sheet and your numbers and whatnot. But really working the portal. And then also, knowing who you're meeting with. Don't go into it blindly. Do some homework on your meetings so you know the type of investors that you could really, tailor your pitch to your specific audience.
Yeah. That's great. That's relevant for investors and also kind of anybody going to these events. Definitely and even maybe if you book early, a lot of times you save money as well.
Yeah, the whole objective, it's only a half-hour meeting, is really planting the seed so that they want to have another meeting with you, and then you could go further, because the investors meeting so many managers, like how many managers a day that are they meeting, like 7 or 10, I don't know, but whatever it is, you really want to stand out, plant the seed, and really to get to the next step and have that more personal, longer meeting with them.
Yeah, it's a great point. Any advice for kind of becoming memorable as opposed to having like great returns?
Yeah, I mean, we usually put a condensed version of a presentation together ahead of time and have that available. So something that's palatable to do in a 30-minute meeting with, and also maybe a different version for a first-time meeting versus a follow-up meeting. The follow-up meeting will be more giving an update of where you are now, how you're positioned, what you're excited about. And then for the first time meetings, you're going to have to give an introduction, of yourself, of your firm, but then maybe go through some, like use ideas to take you through the process, use an example and really bring your process to life by talking about, investors love talking about positions. So that's always helpful, but know that you're only talking for 30 minutes. And if the person's late, maybe 20. So just having like some kind of format that you're practice, because you're essentially going to be just saying the same thing over and over again.
Yeah. Well, that's probably where
get the pitch.
Yeah, you guys coaching them is helpful, right? Because they think they do this in their minds, no problem.
Yeah. But you're right. The coaching is really helpful, because a lot of times, even the managers came from a shop where they might not necessarily have been the person doing the pitching. They might have been, managing money, coming up with great ideas, but they might not have been the front-facing person in the marketing process. So a lot of times it's a learning experience.
Yeah.
And, being coachable, taking the advice, like we've done it a long time. All the salespeople here have been in the business for so long. So they have a lot of insights with the amount of funds and meetings that they've sit in on. So, being able to learn and take constructive criticism. And a lot of times, like you see managers evolve from the first meeting, and then they're like great closers, by the time your marketing relationships in place, you're like, wow, that guy's great.
Yeah, that's awesome. What about, obviously, as a placement agent, you've seen a lot of different things over the years. If someone's going to hire you guys or looking for a placement agent, what are some of the things or they should be paying attention to? Obviously, you kind of mentioned you guys don't charge a fee, a retainer, essentially.
Yes.
Some do. I mean, maybe you can talk about different nuances they should pay attention to when they're looking to hire someone.
Yeah. I think that's one of them, knowing what you're going to be paying for. So we don't charge retainer or expenses. So just know upfront, if you're going to be paying that, what is it? Is it getting paid back to you as they raise assets? Like how the dynamics of that work. Also making sure that the placement agent has the right contacts for you.
Yeah.
A lot of times, if they're only going out to large institutions and you're a small emerging manager, maybe they're really not the best placement agent for you, that you should, go to somebody, more fit. And then, ask around the industry, ask your cap interns, ask your service providers, because most of the time your service providers will know most placement agents out there and third-party marketers, and you can get insights from them. And then also speak to other managers that they've worked with. And, get a feel and ask them other questions about how the experience has been. And, try to find somebody that was in the same spot as you when you started with that manager. So, if you're $25-50 million fund, try to find somebody that started, with that placement agent at the same size and how that experience went. Because if you're going to talk to like a few $100 million fund, they're probably going to have a different experience, in the marketing process than you would. So do your homework, definitely. Make sure it's the right fit, and do your diligence on the placement agent. They're going to do on you, but make sure that about them as well.
Yeah.
How about for somebody that's considering either like a cap intro firm or a placement agent? What are some of the kind of key questions that they should be thinking about?
I think it's really the services provided, and just to see what's a best fit for you. And like I said, with the placement agents, there's even very different, formats where, do you want a full service placement agent, or do you just want somebody to kickstart you or supplement what you're doing now? It's a decision of really finding, and it's the best fit for everybody. What is your nerve? Like, what do you want to be able to handle everything and just get that targeted list from? Maybe that's helpful for you. You don't want to, you'd rather pay like a monthly service. Like we're getting paid on the assets we raise, but it's a percentage of your management performance fees. You might prefer the just monthly retainer and kind of going out on your own because you want to do the marketing or keep it yourself. A lot of times it's also good if you have somebody internally already, and you could use that, like the cap intro as you're talking about cap intro for a hire, right?
Yeah, exactly.
Like having that supplement and help out your internal person, because your internal person, if you're expecting them to cover the world, it's a lot of work. So, if that cap intro service is really as a kind of supplement to what you're already doing and kind of working for them, that's an option too.
Yeah.
Yeah.
What are some typical like contractual mandates of the timeline? Is it a few years that you guys kind of are involved, or what does that look like?
Ours are 2-year contracts.
Yeah. Okay.
I think it's a good amount of time to, really get into market, and it also taking into account of like market environments and times and, investor cycles. So it's a good time. We've always thought. And then, you can renew it from there. But the initial 2 years has always been positive. We've never actually, that I know or remember, have gotten pushback on that.
Yeah. No, it makes sense.
Yeah.
Regardless.
We're in it for a long-term relationship. We're looking to kind of be in it for the long term. I think on average, probably our relationships maybe about 5 years.
Yeah.
Yeah, it's a good point. It takes time.
Yeah, it takes time, with the meetings, travel, and 2 years goes by so fast. Now, like, what?
Yeah. From an investor point of view, is there certain times of the year that investors are allocating, or is it like everybody's different? It seems like for certain programs. Just curious.
Everybody's different. We find that more on the private equity side, like the private equity venture side, that if you don't get on somebody's schedule or calendar or whatever by a certain point in the year, they've already used up their budget for the year.
Yeah.
A lot of times I'll tell like a private equity or venture fund, it's not necessarily the best idea to have like a year-end final close.
Yeah.
Because a lot of times if you'll have spoken to people more towards the back end of the year, you'll want to get into the first quarter of the following year typically. So in case they have to wait for like $2026 to allocate to you, that you get that without having to go back to your, advisory board to get an extension. So that's one thing. I don't see it that much on the hedge fund side, but I'm sure it's there. I just probably don't see it from my role, but I definitely see it on the private side.
Yeah. So I'm assuming when you guys were kind of win a mandate or work with a client, they're coming in middle to year end.
Yeah. And you're like, oh.
Yeah. It could be interesting.
And at that time, the timeline on the private sides, most times it's not. I mean, I'm sure for big, large, established managers maybe, but it doesn't seem to be for the most part 12 months in a year. More, I think it's more 18 to 24 months, it seems to be.
Right.
Mm-hmm.
Where it had always been, 12 months from the first close, and now it's pushed out of it.
Yeah.
Is there things that investors should be thinking about or fund managers should be thinking about when it comes to like, let's talk about like cold email, cold outreach, maybe even social media? Are there any things that you guys, kind of talk about with them on those fronts?
Yeah, I think cold emails make them value added. Make it something that is informative, timely, where it's an interesting read, interesting follow up for the investor. Um, being consistent with sending it each month. Not a lot of our managers do a lot of social. We have one manager that does some social media, but it's not something that a ton of our managers have done that much. I seems to be more like the activist type managers for us that are writing letters and getting their story out there.
Yeah.
But for the most part, I haven't had that much exposure.
Mm-hmm.
Which I'm sure there are a lot of insights on it. I just haven't personally had it.
Yeah. Everybody's a little bit different sometimes, right?
Yeah, exactly.
Yeah.
Yeah.
But we encourage regular communication, like if not a monthly letter, then or monthly missive, quarterly letters, just to stay in front and have that. I mean, more infrequent is not as good. And sometimes if the letters are really good, investors look forward to receiving them.
Yeah. 100%, almost like a research report, get the market insight and whatnot. Could you tell us a little bit about, what strategies are you guys seeing right now that are most favorable from investors?
We're seeing lower middle market buyout, very favorable global macro. So we're seeing that, especially with the environment now. I'm hearing digital asset and market neutral.
Anything like commodities like gold, is that picking up steam yet?
It probably is. I personally haven't seen it, but I could imagine that it would be more commodity type strategies, and maybe like in the CTA world, like a global macro, like focused on commodities, or absolutely. And if people are just wondering where to go right now, and what to look at and what to invest in, and
Up is down, down is up. Yeah. Interesting times for sure. Yeah.
I think multi-manager still.
Yeah.
I think where you're like the fees have been a pushback lately.
Yeah.
On the fee side, you said?
It's like the pass-through fees.
Oh, yeah. Seems like everything's getting scrutinized with fees. That's a great point, though. They're looking at everything from a
Yeah. Especially now, volatile times. I mean, you have to be so careful with your diligence and really making sure that you're partnering, like us partner with the right managers, investors partnering with the right managers. Because, I mean, you're all hoping to have, long-term relationships with these managers, whether it be on the hedge or private side.
Yeah.
And staying with them. So putting in your time up front, getting to know them and, liking them, trusting them, appreciating their insights and really being appreciative of the process they put in place. And risk management is more important than ever right now.
Yeah. Do you see going from a fund manager who launches fund one going to 2 and 3, the conversations and maybe as they work with you and those second to third fund launches, how that is there? Obviously you still have the flagship fund, but then you have another fund that you're adding on as a different strategy. How that?
Yeah. I mean, 2 and 3 are much easier than 1.
Right. Yep.
The one thing like with 2 and 3, or even 2 more so, just having realizations in fund 1, so you could actually see, how your track record is proved out. I mean, it's always helpful maybe you have a past track record you're able to use, but if you don't have that and you have fund 1, but you have no realizations, and because you have no realizations, you're not getting a ton of re-ups, that's hard. But if you're at fund 3 and you've already had a lot of realizations in fund 1 and fund 2 starting to have some, and then fund 3 is just that much easier, and, hoping for re-ups and, hoping to have a diversified investor base so that, if you don't have re-ups, because a lot of times you might not have a re-up for a reason totally independent of you. It could be just because there's been a CIO change or change in investment mandate and strategy, regardless of the fact that you're top decile. You want to make sure that you have enough diversification that, you might have a hole to fill, but you still have a lot of other backers coming into the fund.
Yeah.
Yeah. It's a great point. That's, I mean, as you talk about that, it just gets me thinking like, even when you're starting out, try to get some smaller checks from, I would say like maybe more asset managers. Like, if you could get $100K check from, somebody that's allocating, that kind of keeps them in your network. So you get them, hey, you looking to invest more? Is that kind of something you guys think about at all?
Yeah, and a lot of times, like with the high net worth like type family offices, a lot of times they'll bring in their friends too. Like they have more like consortiums where they share investment ideas, and might have a combined meeting where they'll bring other people into the meeting because they really like this manager and they've done their diligence. And I mean, they're just more of a networking thing. And then also a lot of times, like you said, the high net worth or smaller family offices are sticky because they're they're entrepreneurial. They're, able to stay in. They don't have an investment committee to answer to. And even they might, see the opportunity to add when you're down, because they really like you and you're saying now is a great time to get in, and they'll stick with you. So yeah, institutions are great, but a lot of times like the family offices and high net worth are great investors also.
Yeah.
Yeah.
It's just people want the names of the large institutions a lot of times.
Yeah, of course they do. Yeah, makes sense.
100%. Awesome. Well, Nicole, we've covered a lot here. This has been a lot of fun. Where could people go to connect with you and learn more about Far Hills?
Sure. My email is nbelmont@farhills.com. And plus we have a website if you want to check it out. It's just farhills.com, and we're on LinkedIn too.
Amazing.
Cool. Any type of like managers that, you guys want to reach out, or, other investors that make sense to reach out to you?
Yeah, I mean, we like to talk to any managers and really start dialogue and, enjoy a conversation. And even if it's not a fit, try to be as helpful as we can.
Amazing. Awesome. This has been great, Nicole. We'll make sure to include all that in the show notes as well.